If you've been watching the markets recently and feeling a bit worn down by it all, you are not alone. Price has been choppy and down, confidence is fragile, and a lot of people are questioning what actually matters anymore. Not just in crypto, but in the wider financial system. When markets are volatile like this, it's very easy to get pulled into short-term noise, candles, liquidation, fear, frustration. But moments like these are often when the most important structural shifts happen quietly in the background, completely unnoticed by most people. And that's exactly why I want to talk about Swift today. Not because it's exciting, not because it's going to pump a price tomorrow, but because what Swift has just done tells us a lot about where global finance is actually heading, especially at a time when trust in the system feels shaky. Before we get into this properly, quick intro for anyone new here. I'm Paula, and on this channel we don't just react to price. We look at the bigger picture, the infrastructure, the power structures, and the long-term shifts that shape where money moves next. Because when markets are this emotional, understanding the plumbing matters more than ever. Now, let's get into this, because this is not a simple Swift versus Ripple story. It's something much more subtle than that. Over the last few days, Swift announced a new global payments scheme aimed at making cross-border payments for consumers and small businesses faster, more predictable, and more transparent. On the surface, it sounds like a routine infrastructure upgrade, a modernization, the kind of thing you'd expect in 2026, not something that should shock anyone. But when you actually read the details, a very different picture starts to emerge. Swift is targeting the exact same pain points that have plagued cross-border payments for decades: slow delivery, unclear fees, unpredictable exchange rates, payments that pass through multiple intermediaries and sometimes lose value along the way, customers not knowing how much the recipient will receive or when the money will arrive until after it's already been sent. In simple terms, Swift is now saying customers should know upfront how much they're paying, how much the recipient will receive, and when the payments will arrive before the money even leaves their account. If that sounds familiar, it should. Because that is almost word for word the problem statement Ripple has been repeating for years. And that is where this story actually begins. For a very long time, criticism of the traditional correspondent banking system was brushed off as a crypto talking point, something exaggerated by fintech companies and blockchain startups trying to sell a solution. But Swift's announcement makes something very clear. The system is broken. Domestic payments in many countries already settle in seconds. Faster payments in the UK, SEPA Instant in Europe, real-time rails exist. But international transfers, they still take days. They still pass through multiple correspondent banks, and they still rely on pre-funded accounts sitting idle across the world just to keep money moving. Swift didn't suddenly wake up one morning and decide to innovate. It's responding to pressure. Pressure from fintech, pressure from regulators, pressure from customers. And yes, pressure from blockchain based on alternatives. That matters. Because when incumbents start copying the language of the challengers, it usually means the argument is already lost. Now, here's the important part and where the nuance matters. Swift is not adopting blockchain. It's not integrating XRP. It's not replacing correspondent banking. And it's not changing how money actually settles between banks. What Swift is doing is improving messaging standards, rule enforcement, transparency, and predictability. It's fixing how payments feel for customers, not how they settle behind the scenes. Think of it like repainting the dashboard, upgrading the display, and improving the sat-nav, while keeping the same engine under the bonnet. That distinction is absolutely crucial, because settlement is where real cost lives. Under Swift's new scheme, banks will still rely on correspondent banking chains. They will still need pre-funded accounts in sovereign currencies. Capital will still be locked up to support cross-border flows. Liquidity will still sit idle on balance sheets doing nothing productive. Swift is addressing transparency and predictability. It is not addressing liquidity efficiency, and that is not an accident. Swift's job has never been to replace the financial system. Its job is to preserve it. This is where the conversation around Ripple often gets misunderstood. Ripple was never just about speed. Yes, faster payments matter, visibility matters, predictability matters, but Ripple's core argument has always been about capital efficiency, about freeing trapped liquidity, about reducing the need for pre-funded accounts across borders. In other words, Ripple's value proposition is the balance sheet, not the interface. And that's a very different problem to solve. When Swift improves transparency and delivery certainty, it raises expectations across the entire industry. What was once considered good enough is no longer acceptable. Customers start asking harder questions. Regulators start paying closer attention. And suddenly, banks can't hide behind complexity anymore. Ironically, that helps Ripple. Because once speed and visibility become baseline requirements, the remaining differentiator is settlement efficiency. And that's where Swift draws the line. Now let's talk about why Swift can't cross into that line, even if it wanted to. The correspondent banking model isn't inefficient by accident. It exists because it allows banks to manage risk, comply with regulations, and maintain control over capital. Pre-funding accounts across borders ties up liquidity, but it also provides certainty and stability within the existing system. Replacing that with real-time settlement requires more than better messaging. It requires a fundamental rethink of how banks manage liquidity, credit risk, and regulatory exposure. And that is not a small change. It's not something that can be rolled out globally overnight. It's not something regulators sign off on easily. And it's certainly not something incumbents rush into unless they absolutely have to. Which brings us back to Ripple. Ripple's recent banking pilots aren't about replacing Swift. They're about operating in parallel, in specific corridors, under controlled conditions, with regulated entities. Banks in regions like Saudi Arabia, Switzerland, and Japan are testing blockchain-based settlement models using regulated stablecoins and tokenized assets. Not because they want to tear down the system, but because they want to reduce capital costs in high-friction corridors. These pilots are narrow by design. They're cautious, they're measured, and they're telling, because they show where the pressure is greatest. In capital-intensive or emerging market corridors, liquidity inefficiency matters more than UI improvements. That's where pre-funding hurts the most. That's where Ripple's approach still makes sense, and Swift knows it. This is why framing this as Swift versus Ripple misses the point. This isn't a winner-takes-all battle. It's a slow re-architecting of global payments where incumbents adopt just enough innovation to remain relevant, while avoiding changes that threaten their core structure. Swift's announcement doesn't kill Ripple, it narrows Ripple's lane. And that's actually more interesting, because narrow lanes are easier to defend. There is another layer to this story that's worth zooming out on. We're seeing the same pattern across financial systems. Central banks talking about innovation while moving at glacial speed. Governments explore tokenisation while insisting on control. Institutions acknowledge problems without embracing solutions that fully address them. This isn't hypocrisy, it's strategy. Change is being managed, not accelerated. And crypto's role in this isn't to flip the system overnight. It's to apply pressure, to expose inefficiencies, to force concessions. And that is exactly what's happening here. Swift didn't wake up one day and decide cross-border payments should be better. It was pushed there. Now, if you're holding XRP or watching Ripple closely, this doesn't mean instant price action. And it doesn't mean Swift suddenly loses. What it does mean is that the conversation has shifted. Problems that were once dismissed are now being formally acknowledged by the most powerful messaging network in global finance. And once problems are acknowledged, they don't go away. They get managed. They get experimented with. And sometimes they get solved in places you're not looking yet. This is why price-only narratives often miss what's actually happening. Markets are forward-looking, but they're also impatient. Structural change doesn't move in straight lines. It moves in pilots, frameworks, standards, and quiet announcements that don't trend on social media. This is one of those moments. It won't pump tomorrow, but it matters. So when people ask whether Swift is realising the blockchain threat, the answer is yes, but not in the way crypto Twitter imagines. Swift isn't scared of being replaced. It's adapting to remain indispensable. And in doing so, it's validating years of criticism without conceding control. Ripple sits in that gap, not as a replacement, not as a revolution, but as a pressure valve where the system strains the most. And that's a much more realistic role than most people want to admit. If you've made it this far, this is the kind of context that separates speculation from understanding, and it's exactly why I think content like this matters more than chasing short-term hype. And if you want more of this type of joined up thinking, join me and Milkshake Matty on the UK Crypto Podcast. We drop weekly episodes and they're available to watch right here on YouTube, or you can listen to them on Spotify. If you found this video useful, make sure to like it, subscribe to the channel and share it with somebody who still thinks crypto adoption is supposed to happen overnight. And as always, if you want to know the exact strategies we use in the Crypto Wolf Pack to make money in both the bull market and the bear market, we've made a completely free course for you. It's called the Crypto Liftoff course and the link is in the description below. Thank you so much for watching and I'll see you in the next one.